folks. You're watching the Asset Preservation Hour with Stewart Willis. I'm Joe Wilson. Stewart, we are making history, and not exactly in the good ways. I want to run some economic global things by you, and I want to get your feedback for the viewers today. Since 1994 was the first time the Federal Reserve, the last time, they raised 75 basis points, right? And we just did that and projecting to do it again and again. Since 1994. Stuart, we haven't had a war in Europe in 75 years. And I know you were telling me at lunch today that you had someone that recently came in that had 25% of their retirement assets just in international funds, and they're a conservative investor. So you've got interest rates going up. You've got the Federal Reserve fighting interest rates. We have debt. 4 years ago, we were $20 trillion in debt 4 years ago. Today, we're over $30 trillion in debt. We're making history, not always in a good way. And my Lord, the volatility we're seeing in portfolios. What are the people of Phoenix to do?
Yeah, I think it's really important that people, really understand what kind of risk they're taking. And I think that that's the biggest thing that people are missing is they just don't know. Listen, everybody is bullish in a bull market.
Right.
But when it comes time to these bear markets, now that we're seeing the market down 20+%,
right.
These people that were very bold and brave during a bull market, well, you know what? Now the chickens are coming home to roost, aren't they?
Correct.
They're taking unnecessary risks that they didn't understand. Because what's happened, Joe, is that literally for the last decade, I say it over and over again, a blind chicken could have made money in that market, right? I mean,
it was pretty good time to be saving money.
And so we get a lot of these self-investors that just like to be able to use these very complex terms to be able to relate to these very complicated things, right? It makes us feel like, hey, we're in the know.
Sure.
Here's the reality. When someone comes to me and says, hey, Stewart, where's this market going? I don't know.
Right.
I don't know specifically.
Of course not.
If I knew with all certainty, I wouldn't be, hanging out with them. I'd be on my 500-foot yacht in the south of France,
Isn't that the truth?
Or in the Amalfi Coast where I just got back
Take
from.
me
Right?
with you. Let's go.
Right? But I don't. And here's the thing. That's the one thing we do very well at Asset Preservation is we diversify. We diversify that risk. But I think it's really important to understand that over the last several years, what they've done when it comes to mutual funds, 401ks, even now, the thrift savings plan is bringing on these target date funds.
Target date funds.
It's easy, right? It makes a decision easy. Oh, I'm retiring this date. Let's pick this.
Hit the easy button.
Right? Well, how much are those exposed to international positions? Right? Did it plan on the war from Ukraine? Have they adjusted those suitable positions because of this war?
Correct.
Or are they maintaining those same numbers?
Correct.
That's why it's not asset allocation isn't everything. You also need to have a tactical and strategic approach. It needs to be able to change with the times. We're not in the same world today that we were 2 years ago. We just left the best economy the world's ever seen. And overnight, we're in this terrible position. The one good thing about, I try to be an optimist. The one good thing about all these crazy interest rate hikes, it has strengthened the dollar.
Correct.
And so, I was just in Italy, spent some time in Italy over the summer.
Coin
here.
goes a little further.
We could buy a lot more, but remember what Donald Trump said. And listen, I don't care if you love Donald Trump or hate Donald Trump. It doesn't matter to me. But the one thing he always tried to do is keep a weak dollar. Why? Yeah. Because he wanted to make exports. He wanted people to export the American goods to a foreign economy. And, my son used to be in motorsports, and his teammates, their parents from the UK would always call me and say, oh, the dollar, it's weak, so we're going to go buy. They used to come to the auto auction here every year, the Jackson Barrett. Well, guess what? They're not coming anymore because the dollar's so strong.
They can't afford to come over here.
Right?
That's exactly
right.
They
can't do it. It doesn't make any sense. So it's really going to hurt us in more than one way.
So we're seeing volatility on the dollar. We're seeing volatility in the markets. You brought something up, and I want to bring it up, and I want you to dive into it for the viewers.
Yeah.
The average target date fund, if you will, someone that's retiring 2025, it's designed to be more conservative as you get closer to retirement. That's only a few years away.
Right.
It's down over 14% year to date. The average 2030, that's only 6 years, 7, 8 years away, depending on when your bucket's going to be hitting. You're looking at down over 15% year to date. What if the Federal Reserve continues to just, as they've said, we're going to raise rates to beat inflation? What is the modern retiree to do right now with these target date funds and all their funds in their 401ks and IRAs?
Well, here's the thing, is that for 35 years, interest rates have dropped. right? Over the last year and a half, we started to see this spike in interest rates.
That's correct.
And literally over the last year, we've seen this tremendous doubling of interest rates. And so what that's doing, it's destabilizing bonds. So for 35 years, as interest rates fall, bonds have gone up in value. It's been really good for bondholders. Well, now the opposite is true. And so does it make sense for a 3 or 4% yield to risk 10, 15%?
Right. And people, I don't think, understand how much risk is sitting inside these portfolios. And I know that's something you and your team specializes really when you're doing this retirement ready review and we're looking at these volatile times. I think it's imperative for folks to understand this is the risk that you could be exposing yourself to being invested the way you are. And in many times, it's them hitting that easy button and set it and forget it. And it's time to shift some sails.
Listen, I think you're right on, Joey. I think people just want it to be easy, right? Like people say, oh, well,
sure
2020, 2040, they want to keep it simple, right?
Yeah.
It's the keep it simple, stupid mentality,
Correct.
right? I get it, and normally that makes sense. What's happened, though, with these target date funds is they've oversimplified it, right? And what we're starting to see now is that these target date funds are becoming very profitable for these mutual fund companies, too. And so now what we're seeing is people are now looking at them as commodities. So they're looking at, for example, the 2025 fund, and they're comparing one company to company B.
Right.
And if this one made 7% last year and this one made 8%, we're going to pick the one with 8%.
Right.
So what's happening? How does this one, if it has the same allocations, do better than the other one? You know why? It's because it's taking more risk.
Correct.
And so what's happening is after these target date funds are being commoditized and people are now just comparing rates of return, what we're seeing now is an increasing amount of risk being layered into these target date funds. And I just say this to the audience today, if you have target date funds in your 401k and you're over 59 and a half, you actually have some options that a lot of people don't realize.
That's right.
What we're offering the audience today is a complimentary portfolio review where we will take a look at what kind of risks are you taking inside your portfolio? What kind of fees are you paying? And are the target date funds you're in right for you? You just need to make sure that you understand what those risks are, but you have to take action today. Give us a call at 833-652-7829, or even easier, pick up your cell phone, click on that QR code that's on your screen right now. That'll take you to apsitaxes.com, our website, where you can sign up for a complimentary portfolio review. But you have to get off that couch right now, take action, give us a call.
Folks, you get one shot at retirement, and this is not the time to be cavalierish about your retirement and your life hard savings. You owe it to yourself more than doing retirement planning off of a statement from a big box firm. You need to have a written income plan and know exactly the risk you have. So dial that number, 833-652-7829. Do it today.
Call 833-652-7829 for your own complimentary retirement readiness review and risk report. Why take unnecessary risk when you don't have to? At 65 years old, would you drive to the grocery store at 100 miles per hour if 40 miles per hour would get you there safely? When nearing retirement, are you still driving your investment accounts like you're in your 30s or 40s? Have you changed your investment election since you first chose them in your retirement accounts at work? Call Stewart and his team at 833-652-7829 for your own complimentary retirement readiness review and risk report. Do you know exactly how much risk you are taking in your investment accounts? Now that you've accumulated a nest egg for retirement, you want to be certain the risk you're taking in those investments matches your goals and objectives. Call Stewart and his team, 833-652-7829 for your own complimentary retirement readiness review and risk report, or use the QR code below to begin scheduling your appointment. You may not have time to recover from taking too much risk.
Phoenix, you're watching the Asset Preservation Hour. I'm Joe Wilson, joined with my good friend Stewart Willis. Stewart, we have to address the most recent inflation print coming from the Bureau of Statistics here, 9+%. What is the modern retiree supposed to do with a 9+% print on inflation?
It's absolutely crazy. I mean, I think, it's that hidden tax. It's that, tax people don't talk about.
Right.
No, it's scary. It's very scary. I mean, people are realizing, a lot of these people that have been off to the side in the market, they've had all their money in cash or in cash positions. Their money is now losing 8 or 9% now that, the cost of inflation
Correct.
is separating from what their actual yield is. on that money. So
It's almost a safe way to lose money.
right,
You know?
it's guaranteed. It's like the Chinese water torture of death there.
Yeah.
Just drip, 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 it's going.
I think what's important, and you were talking to me about this at lunch today, when you look at the average inflation rate of 9%, that could be a little bit different here in Phoenix. I mean, this is a little bit different part of the United States of America, a little different than the Midwest or the South. There are some things in the market, some inflationary products and things that people are spending their money on, that's significantly more than 9%. Really, when it comes to retirement planning, I know what you mentioned to me at lunch, it's about the personal inflation rate and how that affects their personal financial plan.
Yeah, I think a lot of people based all of their plans on much lower inflation rates. Look, historically, we were looking at between 2–2.5% for most of the assumptions we made. And quite honestly, a lot of people relied on the government's, words on inflation where they said it was transitory. I mean, clearly now we realize it isn't, right?
Yes.
Are we at peak inflation now? Is it going to start tailing over? We see no signs of that, Joe. Until they do something about fuel costs.
Right.
Because just remember, fuel costs are what are stimulating all of these other problems. I mean, listen, energy is a huge part of our economy.
Massive.
And honestly, I think most economists believe it's being underweighted properly in the CPI. So although it's a massive inflation number, we think it may actually be substantially higher if fuel prices were properly weighted. So I guess at the end of the day, the question is, what does that matter? How is that important to an individual
Well, if you're traveling and driving around this town and it's lovely traffic, I mean, that's a very impactful part to your retirement plan. If you're going to go around and play some golf, you're going to spend some money in fuel. And it's amazing to me how we like to just deal in the averages, the big box Wall Street firms, but a lot of folks' personal inflation rate's a lot higher than 9%.
Yeah, so I have, Jennifer's my amazing personal assistant. She travels with me wherever I go, to whether I'm in the Sun City office, the Tempe office, or in Scottsdale. And so, to me, it was just kind of a normal thing, right? Fuel was inexpensive, no big deal. But now that we're seeing $5–6 a gallon for gas.
A little different animal.
Right? I mean, now I'm saying, here, go ahead and take my card and fill up your tank, trying to be a good guy about it all, because I can't, it's not fair to have her have to pay for her own fuel to do her job, right? It's the cost of doing business.
Right.
And so I try to be sensitive to those things where, a lot of people made their assumptions for work based on the cost of fuel like it was in the past. Things have changed. So what we're seeing is people are starting to look at commuting less, at working closer, to their home. And people are willing to take, even pay decreases to accomplish that too.
Correct. It's definitely shifting the consumer's behavior. I think this is interesting, and one of your team members in the Tempe office brought this up to me. At a 6% inflation rate, your income needs doubles every 12 years. So someone's walking into retirement. Let's say, as you said, maybe inflation tempers back from 9% to 6%. They're still looking 12 years, that income need, if they're planning on $100,000 a year out of their retirement accounts, doubling in 12 years.
It's unbelievable. So what does that do? That starts saying either A, you need twice the amount of money to retire, right? So all of the assumptions you have, throw them away, they're garbage.
Right.
Or you're going to need to get twice the amount of return. So what happens? What does it take to get more return?
Usually more risk.
More risk, right? So that's precisely the time you need less risk. As you start getting closer to retirement, typically what you want to do is take some risk off the table. And I think that what this is doing is putting a lot of people in jeopardy. Listen, I've had to have the real conversation over the last 6 months and year with clients that we're anticipating retiring here over the next year or two. Quite honestly, we have to see what happens with inflation first, because I'm not comfortable saying yes in all cases.
Right.
Where they were done, they were checked out, ready to go, right?
It's just more expensive to live.
Take this job and shove it. They were ready to get out the door. Not anymore, because we have so many new variables out there. The cost of living is just gone through the roof. So I think it's really important for you to assess what kind of risk you're taking in your portfolio. What has your advisor done to adjust, for these new inflationary needs? Are they adjusting? Are they pulling back? Are they hitting the gas, the brakes? What are they doing?
Well, it's interesting hearing you talk that really what you're talking about is your personal income plan. And I know that's what you guys do at your office so well. When that modern retiree is coming in to retire, you really help them understand, here's your personal income plan. And you factored in what inflation could be and things of that nature. And it's ongoing and reviewing. Because the issue is it's hard to stay retired if you don't have your necessities met. And if you have to have those necessities, it has to be part of your income plan, and you have to plan for inflation.
Yeah, so we cash flow out all of our clients' needs. So we really test out all of the needs. But remember, all those plans we did last year, they're garbage now. They're worthless because the assumptions we made are totally different, right? I had a friend, my mentor in this business, he used to say, sometimes you need to just shake your Etch-a-Sketch and start over. It's kind of where we are right now. We're in a whole different world than we were.
Definitely is.
Because I think so many people, have been making decisions during easy times.
Well, it has been easy. Fed's been easy, helicopter money, backing up money and dropping interest rates, and it's just a different world.
Yeah, easy times. Well, the easy button works in easy times, right?
That's right.
That's your quote. And at the end of the day, I think people, these do-it-yourselfers, have been able to rely on just these amazing markets carrying them through. Well, now, when we see this stagflationary environment where things are getting more expensive, but the markets aren't doing well, they're going backwards. Not only is stock market going down, so is the bond market in these rising interest rate environments.
Worst market since '81 in the bond market.
It's crazy, right? Worst start to the year, since the Great Depression.
That's right.
Second worst ever for the stock market.
And inflation at an all-time high.
Unbelievable. So we are in crazy times right now. And I think if, as an audience, you're concerned about what kind of risks you're taking, is your plan going to keep up with the cost of inflation? What we're offering the audience today is a complimentary portfolio review. But you have to take action today. You give us a call at 833-652-7829, or even easier, pick up your phone, click on that QR code. That'll take you to apsitaxes.com. We'd be glad to give you that complimentary review.
Folks, you get one shot at retirement, and in these inflationary times and crazy market volatility, you owe it to yourself and your family to have your retirement planned out so you know you can be and stay retirement ready. Stewart and his team are standing and willing to help you be retirement ready.
Call 833-652-7829 for your own complimentary retirement readiness review and risk report. Why take unnecessary risk when you don't have to? When nearing retirement, are you still driving your investment accounts like you were in your 30s or 40s? Have you changed your investment elections since you first chose them? Do you truly understand the risk associated with your investments? Call Stewart and his team at 833-652-7829 for your own complimentary retirement readiness review and risk report. Do you know exactly how much risk you're taking in your investment accounts? Now that you've accumulated a nest egg for retirement, you want to be certain the risk you're taking in those investments matches your goals and objectives. Call Stewart and his team, 833-652-7829 for your own complimentary retirement readiness review and risk report. Or use the QR code below to begin scheduling your appointment. You may not have time to recover from taking too much risk.
Phoenix, you're watching the Asset Preservation Hour with Stewart Willis. I'm Joe Wilson. Stewart, we've got a little window here talking to you and your team. Man, you guys are all over this tax thing. We've got to talk about the current tax environment and the changes that are staring us right down the road.
Yeah, I mean, here's the thing. We are, and I've said it multiple times, we are in the most efficient tax window in history right now. Don't care if you love Trump, don't care if you hate Trump. During the Trump tax cuts, we saw some of the biggest tax cuts to the middle class we've ever seen. Now, remember, at the end of 2025, those tax cuts are going to sunset. So, Joe,
just a few months away, really,
few
handful of
years.
months away.
Yeah, I mean, what we're trying to do is say, look, you need to take advantage of this window because it's closing.
It is closing.
Listen, a lot of our clients have done what they were supposed to do. They did their job. They put their money tax deferred away because they were told that essentially they would be making less money in retirement than when they were working, so they'd pay less taxes. and it's a faulty logic.
It is.
Yeah.
It is. When you look at what we have done just in the national debt, I was doing some analysis because this just fascinates me because I heard you talking about this. Went back, looked up 1980. You know what our national debt was? It was $908 billion. We're $30 trillion today in debt. We were at $20 trillion 4 short years ago. Do you have any of your clients that think taxes are going to be lower?
Yeah, I mean, listen, let's get real. You know, when Trump was able to lower taxes, he did it during the greatest economy, greatest stock market in history. Way easier to do. Now we have a horrendous economy. And, you know, when we have a bad economy and inflation still, that's a really nasty mix.
Tough. Yeah.
Stagflation is a scary place.
It is.
Right? It's kind of like an airplane that's lost its engine, right? And it's trying to fly backwards.
Just fluttering through.
Right? It's a mess. And so I think right now, listen, there are a couple things that you can do to take advantage of where we are. Once again, if you take advantage of this specific window of time, you will love it for the rest of your life. Now, here's the thing. Oftentimes, people don't even consider taxes in their tax plan. Most financial advisors say,
that's right.
You know, we've talked about Roth all the time, and people will say, well, I talked to my financial advisor about a Roth conversion because we watch your TV show, and the financial advisor says, oh, well, go talk to your CPA. The CPA says, talk to your financial advisor.
No one can get on the same page.
Yeah, the right hand doesn't know what the left hand's doing.
That's what's so great about your practice. You guys do taxes. You do tax planning.
Yeah, listen, running a tax operation is the biggest headache in the world. And I don't do it to make profits. We lose money running a tax office. We do it because we can gather some of the best data possible on your specific situation. Here's what I mean specifically. So let's say that you have a certain amount of earned income, capital gains, dividends, IRA distributions. We can create financial models adding in additional IRA income, for example, from a Roth conversion, because most people realize that tax brackets work in kind of funny ways. So going from the 10% to 12% bracket, to me, is a small jump. 12 to 22 is a huge jump.
Big jump.
22 to 24 is a small jump, and then 24 to 32 is a huge jump. So you generally want to avoid those huge jumps. But what people don't understand, a lot of the do-it-yourselfers try to listen to us and do it themselves. The reason that's dangerous, because there's a lot of little landmines out there that you may not be aware of. For example, the net investment income tax. People know it as a Romney tax. It's that tax when you have over a certain dollar amount of income, then other sort of passive sources of income become taxable.
That's right.
And it can add an additional tax. Not only that, right between the 22 and 24% tax brackets is something called IRMA. That's that penalty on Medicare. So you just really want to be careful when it comes time to tax planning. And we always tell people, if you're doing tax planning during tax season, you're making a tremendous mistake. Because listen, God bless them, Joe. These tax professionals work their tails off during tax season. They're working 10, 12, 15-hour days to try to get these taxes done by April 15th. But they're working so much, they become like zombies. They're just trying to get these tax returns done. They're in a rush. You don't want to be in a rush when it comes time to your tax planning. You want to be able to be calm, spend time, be deliberate with your planning, and really make sure that they're looking out for your best interest.
Stuart, we've got so many of these folks that are watching this show, in just the statistics of the modern retiree. There's so many folks that are getting ready to cross over that retirement threshold and begin their retirement. And they save so much money in their IRAs and their 401ks. And I think what's so important is we're talking about taxes. You can only spend in retirement after tax dollars. And so if we're seeing taxes going up and we're seeing the national debt continue to run out of control, we have no idea what Congress and legislative risk can do. That's why it's so important to work with a comprehensive financial planning firm like yourselves that can do this entire thing and look at it as a whole. Talk to us right now about the impact you're seeing on folks that are taking I love that you call it this, your Roth conversion challenge.
Yeah, so well, first of all, the Roth conversion challenge is asset preservation challenging you to find out whether or not the Roth conversion makes sense for you, okay? Now, what the Roth conversion challenge is, what a Roth conversion is, it's about once you have an IRA or a 401k, you can actually convert your retirement accounts, pay the taxes now so that you don't have to pay them later. Now, the argument that we're making is that in many cases, if you pay the taxes now before you retire, even though you're still working now, the 24% bracket, remember, it's going to revert to, to the 28 to 33% bracket.
Right.
So we're going to see a much higher bracket down the road anyways. And remember, Social Security. Social Security doesn't have to be taxed in all cases, but up to 85% of your Social Security can be taxed because it looks at all of your other taxable earning. When they look at your provisional income, which determines the taxation on Social Security, what's included in that is your capital gains, your dividends, any wages, right? Any IRA distributions, your pensions, your 457s, thrift savings plans, all of those income sources are added together and plus 50% of your Social Security benefit. If it crosses the threshold of $25,000 as an individual, 50% of your Social Security benefits taxable. Up to 85 becomes taxable. But with the Roth, it's completely invisible to the Social Security system. It doesn't affect taxation on Social Security. So you're coming into us to plan for the 500,000, the million, the 2 million you've saved. Why not plan on plan around the $1 million you have on Social Security? For us, it's a tremendous mistake. If you want help, if you're concerned that you may be building this tax time bomb, I say it's time to reach out. Give us a call. For the first 20 callers, if you give us a call at 833-652-7829, or even easier, pick up your phone, click on that QR code, we offer you the complimentary portfolio review. But you have to take advantage of it today.
Call 833-652-7829 now to receive your complimentary tax map with your retirement readiness review. Learn multiple strategies that can protect you from higher taxes now and in the future. Taxes are a threat to your financial stability in retirement. Protect yourself from the potential threat of rising taxes. As a retirement planning financial advisory firm, Stewart and his team will help you navigate the financial waters to pursue your retirement goals. Call 833-652-7829 today. Stewart and his team provide inclusive retirement services such as investment directives for your portfolio, income producing strategies, and wealth preservation plans for your family and legacy. Call Stewart and his team, 833-652-7829 now for your complimentary tax map with your retirement readiness review. Discover tax strategies to keep more of what you have saved in retirement, or use the QR code below to schedule today.